I will be talking about some of the consequences of this potential reform from a practitioner point of view. Since the credit crisis, a large number of regulations concerning the financial sector have been produced. CRD4, EMIR, LCR, NSFR, leverage ratio, BDDR, MiFIR, fundamental review of trading book, FRTB, just to mention a few of them. This has resulted in changes to the capital requirements, liquidity coverage, resolution scheme, reporting requirements, market structure, and counterparty risk mitigation with CCPs. Capital requirement from before credit crisis up till now has almost doubled for transactions, which has increased stability of the financial sector. The asset quality review performed recently demonstrated the robustness of larger European banks. Much of the regulation mentioned before are not fully implemented now, but it is in progress, and we will see the impact from this from 2015 up till 2020. The question is if anyone is having the full overview of the combined effects on the financial sector and the European economy from all the regulation initiatives. I don't think that this is the case. The timing of the structural reform may therefore not be right, and the related question is there a need for a structural reform given all the regulation that is under implementation that is also addressing financial stability? With all the regulation under implementation that are addressing financial stability, I don't think that is needed. The structural reform is a regulation that has as its goal to increase stability of the financial sector in Europe and in that way support economic growth in Europe. We agree with the intentions of the Commission and the Rygaard Group, but the proposal in its current formulation may not meet the goal of increasing stability in the financial sector and support economic growth in Europe. The problem with the structural reform is the thinking related to separating banks into a deposit entity and a trading entity. Today we have three types of banks. The traditional deposit bank providing loans and credit services, investment banks providing capital market services, and the universal banking model that are providing the whole range of services from loans and deposit services, cash management services, to capital market services, and that is in demand from retail, corporate, and institutional customers. The universal banking model has the highest embedded risk diversification among the three banking models, as traditional banking risk and risk in trading operations are not perfectly correlated, and that means that there is an embedded diversification between the two. The consequence of the structural reform is to split the universal bank into a traditional deposit bank and an investment banking entity, which will mean that the diversification is lost and the two new entities has higher risk on a standalone basis compared to the universal bank in terms of likelihood of defaulting. The goal of creating a more stable financial sector may therefore not be obtained by this initiative, but the result could be the opposite. Focus in the proposal is on trading activities in general, while many of the banks that came into problems during the credit crisis had problems in their loan books related to real estate. There are potential negative effects on the real economy from the structural reform proposal. One of the important roles for trading operation in the financial market is to provide market liquidity, which is a foundation for having an efficient financial market. Governments are funding themselves issuing government bonds. Corporates are funding themselves issuing corporate bonds. Mortgage buyers are financing their houses in banks or mortgage institutions that issue mortgage bonds. Investors such as pension funds and other institutions are buying these assets. Governments, corporates, pension funds or banks are hedging their market risk exposure via derivatives. All of these activities are based on that there is a liquid financial market. Market liquidity is provided by the market-making functions. That means that banks are quoting buy and sell prices on bonds, derivatives, based on risk positions they have obtained in trading books related to other customer transactions. If they, for instance, didn't have an inventory in a specific corporate bond, it may not be possible to quote a meaningful price on this bond that the customer could trade at, because they may not be able to get hold of the bond to execute the trade, and the prices they would be quoting would therefore be useless. One could then argue that the expansion of agency-based trading models driven by electronic-based solutions require reduced warehousing of risk. That may be true, but what is forgot here is a large part of the mortgage bond, corporate bond, and derivatives markets that do not have the needed liquidity to support electronic solutions, and many customer transactions require balance sheet. So the principal trading model is also in the future needed in market making, which means that risk will need to be warehoused in trading books. An inventory of bonds in a market making operation is financed from borrowing transactions in the financial market. A universal bank that has been separated will face higher funding costs for their trading entity due to that risk diversification has been lost, and the entity is therefore carrying a higher default risk on an isolated basis, which means that cost of running a bond inventory goes up. What are the consequences of that? If transportation costs and cost for warehousing oranges suddenly rises, then the market for oranges will change. Smaller shops far from producers will stop selling oranges. It is too costly. And the prices of oranges will increase and be less liquid, as there will be fewer shops with lower inventories for consumers. Similar in the financial market, the consequence will be of less liquid markets, that the interest rates on bonds will increase, and governments, corporates, and mortgage owners, i.e. end users, will face higher borrowing costs. And especially smaller markets, like for instance the Nordic government and mortgage market, will be impacted significantly in a negative direction from this proposal. Higher rates will have a negative effect on supporting the European economy, so the effect from the structural reform initiative could be counterproductive to initiatives in supporting economic growth. Therefore, the structural reform regulation in its current formulation could end up not increasing stability in the financial system and be counterproductive in terms of supporting growth in the European economy. If the structural reform is to take place, it should therefore be based on preserving the universal banking model and secure that market-making operation is part of the universal bank. Thank you.